a Chinese dietary nutrition company, built on grain powders and sesame and nut snacks, science-backed Chinese grain nutrition, milled and blended for daily use. That's Natural Food International. Based in Shenzhen and listed in Hong Kong, the group sells through concessionary counters in supermarkets, across e-commerce and social commerce platforms, and via new channels like membership retailers and festival gifting. The promise the company puts forward is simple, ancient formulas validated with modern nutrition science, carefully sourced and precisely processed. But beyond the tagline, what does the records actually say about the products, the channels, and the mode the company claims? Let's break it down. Natural Food International is a Cayman investment holding group operating from Shenzhen and listed on the Hong Kong Stock Exchange. It owns a portfolio of dietary nutrition brands, and the flagship platform, Wǔgǔ Mófáng, positions itself between traditional dietary nutrition and modern validation, with a clear promise, ancient formulas, validated by modern nutrition science, sourced from the best, and precisely processed. On capabilities, Feelings highlight two pillars: the Grain Nutrition Research Center and the Research Institute of Black Sesame for food and nutrition, used to formulate products and support the science-backed positioning through standards and third-party tests. On production, the group initiated a processing base in Nansha in 2018, planned to lift maximum capacity to around 40,000 tons per year once fully operational. In its prospectus, the company explains this capacity build with two facts. First, utilization at existing facilities run above 100% at times due to overtime to meet demand. And second, it expected category demand to grow and stated the incremental capacity will support revenue growth. In parallel, the IPO use of proceeds allocated around 60% to Nansha and 35% to enhance the distribution platform and optimize the channel mix. In 2019, PepsiCo acquired around 566 million shares at 1.8 Hong Kong dollar from existing shareholders in an off-market transfer. The company described this as PepsiCo's first strategic investment in China at the time. Keep the 2018 capacity plan and 2019 strategic shareholder in mind. They frame what happens next in revenue and channels. Start with what's on shelf. The portfolio is tight and recognizable. The flagship walnut sesame black bean powder, channel-tailored dietary nutrition gift boxes, and ancient formulas that reinterpret traditional recipes with modern nutrition validation. Around this core, sit the black nutrition universe: black sesame, black bean, powders, and sesame-based snacks, and Little Genius nut snacks. Now the market lens. This is a highly fragmented space. Legacy black sesame and grain nourishment incumbents, e.g. Mofang black sesame, adjacent oat cereal players, e.g. Seameal, Quakers, newer online native powder brands, e.g. Wǔgǔ Mófáng, traditional nourishment houses, e.g. Tongrentang, and retailer private labels all compete for the same consumer. The battle is less about hard IP and more about brand trust, distribution breadth, and content commerce execution. A critical disclosure caveat: The company doesn't publish revenue by brand or product. It cites platform rankings, e.g. number 1 natural grain powder on Tmall, but platform badges aren't revenue share, and Tmall is only a slice of the online channel. In practice, investors must anchor on total group revenue and channel mix, not brand splits. So let's anchor on the group's revenue first. Revenue was about 1.8 billion RMB in 2018-2019, fell to 1.44 billion RMB in 2020 with COVID, then rebuilt 4 years in a row to 2.06 billion RMB in 2024. That's the plan in action. Prune weak canters, take the 2020 offline hit, then climb back as online scaled and new channels, membership retailers, distributors, festival gifting, kicked in. By 2024, offline is steady, online still big, so growth comes from a broader, healthier mix, not a one-off spike. Set that against the EV to revenue line. It drifts down and even turns negative in 2023-2024. Not a glitch, just cash piling up with no net debt compressing enterprise value. The recent uptick is simply the share price rally lifting the ratio. Now that we have seen the revenue trajectory, let's zoom in on the three main drivers of margins and earnings. First, sales mix. Margin tracks channel mix. Online is lower margin. Today's mix is roughly canters around 38%, new channels around 17%, and online around 45%. Second, raw materials and manufacturing. COGS equals sesame, walnuts, beans, grains, packaging, labor and manufacturing. And finally, marketing and traffic. Below gross profit, platform commissions, traffic buying, and counter labor, leases, drive S&D. Promo intensity on e-commerce, social commerce is a real swing factor. Given the 2022 reclass breaks gross margin trends, we rate performance directly through EPS. We start at 6.48 cents in 2018, then 5.74 cents in 2019. 2020 dips into a small loss, minus 0.66 cents, with an online shock and heavier discounting. From there, it's a clean rebuild. 3.95 cents in 2021 to 8.66 cents in 2024. A new high. What changed? 3 things. Mix and pricing, more higher value stock keeping unit, promo pressure eases, channel balance, offline stabilizes while online stays strong, new channel add volume without heavy fixed costs, and operating leverage. In 2024, revenue grows faster than costs, so more drops to the bottom line. Now zoom out to demand. CIC sees the category compounding at around 8.2% through 2027, edging consumers, daily nourishment habits, gifting. But near term, the chessboard shifts. Content e-commerce and membership formats grow as hypermarkets shrink. Management plans to close around 210 lower productivity counters in 2025 to lean into faster channels. With the earnings path and demand drivers mapped, let's open the balance sheet. Property, plant and equipment per share stays roughly 0.13, 0.15 from 2018-2024, because although PPE rose with Nansha, the share count jumped post-IPO and then stayed basically flat, so on a per-share basis, it looks steady. Market cap over tangible equity derated from 2.6x in 2019 to 0.6-0.7x in 2023-2024, and now around 1.14x. i.e., the market priced the stock near below tangible book for years and is only starting to re-rate. Now the plumbing: cash, debt, net cash, structure on screen. Debt is negligible, while cash climbs from around 0.63 billion RMB to around 1.11 billion over 2018-2024, taking net cash from minus 0.56 billion to minus 1.10 billion. Translation: an unlevered, cash-heavy balance sheet. Reinvestment needs next, capex on screen. The 2018-2019 spike reflects the Nansha build-out funded by the IPO. With capex back to maintenance, we turn to working capital. Nothing unusual to flag. The cash cycle stretched to 61 days in 2022 as receivables ran longer, inventories built up, and payables shortened. By 2024, it tightens to 37 days thanks to stricter credit control, leaner inventories, and improved supplier terms. Cash translation next. Free cash flow per share and price to free cash flow. Free cash flow per share climbs from 0.02 in 2018 to a record 0.114 in 2024, with the rebuild accelerating after 2021. On the line, price to free cash flow compresses from the high 50s in 2018-2019 to 4.2x in 2024. Then, ticks back to 7x at today's price. The shape makes sense, with capex back to maintenance and a tighter cash cycle. More of each yuan of earnings drops through as cash. With free cash flow strengthened, the question is returns. Bring up return on equity. Return on equity dipped into negative territory in 2020 with a COVID shock, then rebuilt year after year to 12.9% in 2024, a solid level. What makes it more impressive is the denominator. Shareholders' equity rose from 1.07 billion RMB in 2018 to 1.52 billion RMB in 2024, plus 42%. So returns improved on a larger base rather than via leverage. Quick note that step up in equity didn't occur between 2018 and 2020. Equity was roughly flat over those 2 years. The base really expanded post-2020 through retained earnings. Shareholder returns next, dividends on screen. Despite a large cash pile, the board has been conservative on distribution. They skipped the final dividend in 2020 at the height of COVID, consistent with a policy that flexes 20 to 40% with cash flow and conditions. They paused again for financial year 2022 amid offline volatility and channel reshuffle. Since then, they have resumed dividends at the upper end, indeed slightly above their 20-40% payout ratio policy, roughly 46% for 2023 and 43% for 2024. At today's price, that works out to 4% dividend yield. And how the market priced that? Regression channel on screen. After the IPO, the stock slid hard as COVID and channel disruption hit. From late 2024, it re-rated sharply, helped by the financial year 2024 print, rising almost in a straight line. Today, it's around 0.9 Hong Kong dollar, still below PepsiCo's entry at 1.8 Hong Kong dollar for 25.8% back in 2019. So where does that leave valuation? At today's levels, we are around 9x 2024 earnings, which feels correct, not exciting. Fair value for a niche, steady brand in China. Market cap is around 1.1x tangible equity, i.e. near book and modest, while EV to revenue, around 0.3x, is very low because of a heavy net cash position. Price to free cash flow is around 7x, on the low side for a consumer name with maintenance level capex. So at its best, Natural Food International is a steady, execution-led consumer brand. The Wǔgǔ Mófáng brand sits in a sweet spot between heritage and validation, with a clear hero SKU and a coherent black nutrition identity. Credibility isn't just marketing. The Grain Nutrition Research Center and the Black Sesame Institute give the product line real standards and a professional cadence. On go-to-market, the mix is balanced. Counters for trust and sampling, e-commerce for repeat, social commerce for traffic, and new channels for breadth, plus the discipline to prune weak locations. Financially, it's a cash-heavy, unlevered story that converts earnings cleanly. Capex is back to maintenance, working capital is tighter, free cash flow per share is at a record, and return on equity has climbed to 12.9% on a larger equity base, i.e. better returns without leaning on leverage. Dividends have resumed near the top end of a payout ratio policy, signaling confidence and discipline. Finally, PepsiCo's strategic stake adds credibility on category building, and the structural demand tailwinds, aging demographics, daily nourishment habit, gifting, support a durable, medium-term runway. Despite the positives, there is shadows. First, growth has been anemic over the cycle. Top line only clawed back to the 2018 level in 2023, and it's just in 2024 that revenue finally pushes above 2018, i.e. 6 to 7 years of very low headline growth in a hyper-fragmented, copyable category where pricing power is fragile. Second, disclosure isn't perfect. The company no longer updates market share in recent reports. At IPO, they quoted a 1.7% retail share in 2017 and ranked number 2 nationwide. But that data point hasn't been refreshed. They also don't break out revenue by brand, so investors cannot tell how much the hero SKU contributes. Not alarming by itself, but it does leave a blind spot in the analysis. Third, capital allocation is ultra-conservative, maybe too much. Despite ample cash, the board skipped the 2022 dividend. The cash pile remains large, with no disclosed major project or M&A beyond maintenance capex. Buybacks have been minimal. The 2020 program retired less than 1% of the base, and the company didn't lean in when shares were depressed in 2023-2024, at times trading around or even below the group's cash, yet still executing no repurchases. The stance keeps risk low, but it dampens capital efficiency and, frankly, can read as under-ambitious. And finally, mix risk. Online likely regains share over time. It's the lower margin channel per filling. So margins face pressure, unless pricing portfolio offsets. Now my take on valuation and entry points. As always, not financial advice. At around 9x 2024 earnings, this looks fair rather than exciting for a microcap niche brand in China. The category should grow with aging demographics, but there is no hard moat, so I can't assume Natural Food International captures all the demand. The net cash balance sheet and resumed dividends make it a defensive value title name. At around 0.9 Hong Kong dollar today, the entry point isn't bad, especially versus PepsiCo's 1.8 Hong Kong dollar in 2019, but after the near vertical move since late 2024, I'd like more margin of safety. On my numbers, PE8 lines up around 0.75 Hong Kong dollar, which is where I'd get interest to start a position and add on pullbacks. Thanks for watching this deep dive until the end. If you found this analysis useful, feel free to like, subscribe and share this video. Interested in this stock at today's price? Let me know in the comments. And if you are into consumer brands, check out my video on Chaddy, the new style tea chain shaking up the category.